So remember in the last piece I showed you that you have to do sales revenue, credit, accounts receivable, debit, uh, and then you also have to show the expense, right? The cost of goods sold and merchandise inventory. So the reason you have to do all this is show the money coming in and the money going out, that because that's part of the earnings process. You have to clarify the whole thing. And it says on on May 7th, now the next entry, right? It says that in part A, it says on May 7th, Baker returns 200 units because they did not fit the customer needs. Allied Parts restores the units to its inventory. So now 200 units are coming back, and basically now you have to reverse the whole earning process. But remember, this is where I said in the fundamental concepts in this chapter that we will, when the things come back as return, uh, the seller in the merchandise business recognize it as into a separate account, call it sales returns and allowances. Okay. And of course, because 200 units are coming back, 200 units, and the selling price was 14, so this is going to be 2800 units. And the whole related accounts receivable asset that we created will be reversed now, because so we're going to credit it and reduce it basically. And the story will not end here. We will complete the earning process. Remember, we have recognized the cost of goods sold, which is an expense, right, for money going out. Now it's not going out because the sales being returned, so we have to do merchandise. This inventory is coming back to us. Merchandise inventory is going to be debit for 2000. Why is 2000? Because it's 200 multiplied by 10, its cost. And the related account is cost of goods sold. That expense account is not going to be an expense anymore because it's the inventory coming back. So we are putting this account as well. Account credit $2,000. So I want to say something here again, that in the first one we recognize sales return and allowances because remember, this is bad news for a merchandising business, and we want to know in a separate account what are those bad news, so that the investors, whoever is going to read these financial statements, who's going to read these accounting statements, can understand the performance of this merchandising business, about the earning process. So if there's too many sales are being returned, that's not a good sign. So that's why we put them in a separate account. And all we did was we just reversed what we did earlier, the whole complete reversal of the earning process. We reversed the cost of goods sold, and we reversed the sales, but this time through sales return and allowance account. Okay, thank you.